Hello and welcome. You're watching KYC. I'm Harsh Saita. Now the travel space is obviously going to get some boost. One is GST, of course, and it's also global travel as well as domestic travel, which is doing fairly well for itself. One stock at the center of all of that is the TBO Tek, and what I want to know with regard to it is that it's made a recent acquisition. It's a North American acquisition and therefore gives it access to North American market. By the way, TBO Tek is more like a platform, B2B platform company, buys inventory from hotels and sells to other businesses. So you'll have other platforms or Make My Trip, etc., where TBO Tek enables sale. So that's the general nature. Now, what does this acquisition give them in terms of market, of course, but also in terms of existing business? And could they have done this organically? So these are the two pieces which I'd want to know first off, right off the bat. The third piece is I'd want to know what this does in terms of immediate top line impact. I spoke about that, gave you a hint of that, but that's broadly the way in which I see this. Also further acquisitions, some color around that is what I'd want to know. Now travel trends, both global as well as India. Mind you, 75+% of TBO Tek's top line comes from global facing businesses. So you want to know whether that part of the business also continues to do well or not. And of course India, because GST and all of the tailwind that we're seeing with regard to hospitality in India, that itself gives the India tilt. Can you double your top line in 3 years? Now this is the question which may or may not get us an answer, but I'm going to try and get us that answer, because they've hinted, they don't generally guide numbers, but they've hinted that they will do 20% plus. So I'd want to know this. The sixth piece is with regard to upsides to margins, because as you scale a tech business, there is an upside, but I want to understand how much is the upside, because at least the guidance doesn't seem to suggest a very, very strong upside, but some upside is starting to appear in that sense. And of course, number 7, competition. If you have the likes of a Skyscanner in the B2C space, and if you're in the B2B space in comparison to that, I'd want to know what are the other competitors doing in this space, and is there a larger opportunity for them, and what it does to therefore pricing as well, right? Because the business model is also unique, and let's straight away get to it. It was incorporated in 2006. This is an overview. It's evolved from a single product air ticketing company into a leading global travel distribution platform. Distributes purely B2B, mind you, not B2C, so it doesn't sell to you. It's a proprietary technology, seamlessly connects travel buyers and suppliers, including agents, by the way. So you have agents listed on this TBO Tek platform, and when they make bookings through the platform, TBO Tek makes money. Now let me try and again go back to the slides. Ensuring streamlined transactions across diverse landscape of global travel. They have around 189,000 registered buyers and 13.2 million plus transactions that they do annually. Let's talk about the products and a wide range in which they now operate in. They started off with only air travel, but look at the whole host of products and services they do now, and of course it is rapidly expanding. Outside of this, it could be cruises, it could be, there you go, so you already have that, cargo, cruises, sightseeing, transfers, all of that is what they currently cover. Now let's talk about the business model. It earns in two possible ways. One is when you make a sale, it makes a commission, so that's one model. The second model is it buys hotel inventory, marks it up, and thereafter sells it. So these are the two models in which they operate, and it's the net commission from what we understand is 3 to 4% from airlines and 6 to 8% from hotels. So your hotel composition is far more than the airline composition. It sells technical software related services, providing a shell website which the customer can use as a B2B hotel service provider by adding their own suppliers. So that's broadly the way in which they do it. Let's look at the platforms, and they'll come up on your screen one by one. That's TBO Academy. It's the learning platform for travel agents and travel trade partners. You can actually go in and learn and thereafter register. It has comprehensive Booker Rewards program exclusively for buyers. Let's talk about, and that's TBO Plus. There's Zamzam and Kizan, focuses on religious travel in Saudi Arabia. There is Paxis, a web and mobile-based platform for corporates. So that's the other angle. There's Travel Partner Solutions, enables the partners such as loyalty programs to sell travel products globally. And then there's Roma application, e-travel pockets, pocketbook for travel agents and travelers around the world. And mind you, they continue to make acquisitions, right? So they continue to do that, and that obviously adds to the product portfolio or the bouquet as well as the geography. Look at the overseas presence that they have. They have it across the board, Middle East, all over, Brazil, China, and USA, Egypt as well. So some presence in Africa as well, South American presence also there. So that's just the broader outlook of what TBO Tek does. Now let me talk about the metrics, and we'll start off with the first one, the income statement, the balance sheet, the cash flow, and we'll give you the 3-year numbers for these. Thereafter, we will switch over to the return ratios, the shareholding, street cred, valuations, and street coverage. We'll cover all of that with regard to where TBO Tek is concerned. Mind you, listed in May of 2024, so it's not a very a seasoned listed company, if I can call it that. But it's a 17,000 market cap, 17,000 crore market cap company. So in no way a very, very small company either. So again, just some trivia. Now let's start off with the income statement, and you have it in front of you. 18% top line growth is what they've done. EBITDA has gone up by 120% nearly on a CAGR, 3-year CAGR basis, and profitability has gone up 90%, 3-year CAGR. So you're seeing very strong profit tailwind. Those margins have inched higher, and clearly that's a thumbs up, no complaints with regard to that income statement. I'd be surprised if there is any complaint to that. It's looking like a very, very solid income statement overall. Now let's talk about the balance sheet, and even the balance sheet in terms of the debt is not looking exactly too large. So while we continue to make acquisitions, the borrowing number is just at 136 crore. This is both short-term and long-term combined. You've got equity of around 1,200 crore. Mind you, it's a 17,000 crore market cap company as of today. So you want to also derive the price to book. That's what it is. But it's sitting on pretty much good cash and bank balances. Look at that cash and bank balance. It's looking very, very healthy, and therefore clearly a thumbs up. They need to put that into play, whether through acquisitions or otherwise, and that's likely one of the pieces that we will also get some color on. Let's talk about the cash flow now, and the cash flow numbers will flash on your screen. You've got the cash flow, which has been on an improving trend. If you look at the realization, CFO to EBITDA, quite decent in that sense, no concerns. Now, one piece that you'd want to know is that think about this from a business perspective. You make a booking, you make a payment, and therefore your cash flow will typically be healthy. And TBO Tek will make either the margin or either a fee on that booking, and therefore no reason why there should be a cash flow mismatch. Typically receivables are low, that's just the nature of the business. Also, inventory isn't too high, and therefore you've got a decent kind of run where CFO to EBITDA is concerned, and no concerns with regard to that as well. So we've given that a clear thumbs up. Now let's talk about the fourth metric. We'll talk about return ratios. In terms of the return ratios, again, extremely strong tailwind that we saw. It's come off because they've raised money, and therefore you've seen those return ratios shrink a bit. I'm not sure how much will that shrink as capital gets allocated. Also, you've got a solid pile of cash that they're sitting on. So I'd want to understand as to how this evolves as well. Is there a target number? But broadly looks quite solid on an overall return ratio basis. 53, 43, and even prior to that it was at 18. Of course, FY21 was a muted year for travel. But after that as well, you've seen a resurgence where the return ratio is concerned, and it's doing fairly well for itself. So we've given that a thumbs up as well. No complaints over the last 4 to 5 years. Let's talk now about about the shareholding pattern. And promoters hold around 45% of stake in the company. There's been no major change, but because it's below 50, we've given this a neutral, as we always do. FI holding is decent, but they've seen some amount of selling. DIs have seen very, very strong interest over the last 5 odd quarters. And therefore, you've seen what you've seen in terms of the shareholding pattern. We've given this a neutral broadly because of those factors that are playing out on the shareholding side of things. Let's talk about the street cred. And since May of 24, the stock has not done exactly much, especially since listing. So since listing, if you're holding it, it's not given the best return. But at the same time, if you've bought it at maybe 6 months back, you've got a very solid return for it. So we've given this again a neutral because it's a fairly range-bound kind of return if you're looking at it from a 1.5 year perspective. But from a 6 to 8 month perspective, it's been quite strong in that sense. So that's broadly the take on the street cred. Let's talk about the valuations now. And when you stack it up against some of the B2C players in the same industry, in the same space, you'll see that it's obviously valued at a much, much richer multiple. But that's also because it's tech-based, one. Second, it's multi-country, so there's no focused geography there, and therefore that gives it a more broad-based risk profile. And third is because it's decently fast growing, which all the others also broadly are. It's not like some of the others are not. Of course, a couple of those three have some issues or concerns in themselves, but outside of that, it's a fairly good mix where travel is concerned to grow at a 20% odd kind of growth clip. So broadly, that's the take with regard to the price to earnings, but it's certainly expensive, and therefore we've given that a thumbs down. That's the only thumbs down that we have at this point. Let's talk about the street coverage and wrap it all up. In terms of the street coverage, there's 7 buy calls, 1 hold call, no sell calls. The average upside is 15%. So you've got a decent runway, it seems, at least that's what analysts seem to suggest. There's a decent runway overall in terms of the average 12-month upside as per analysts on Bloomberg. Let's talk about all of the ratings. Let's stack them up, and they'll come on your screen in just a minute. There you go. The income statement, can we rewind the slide, please? So the income statement, again, you've seen very strong growth here, so clear thumbs up. The balance sheet, good cash balances, we spoke about that. We also spoke about the fact that there's very low to no debt. Cash flow, well, it's a clear thumbs up. We spoke about the way in which they generate cash, and therefore typically should not be a concern. Return ratios were solid, 18% at FY22, currently sitting at 27%. Very good for an Indian company. Shareholding pattern is a neutral because of all the changes that have happened. Hopefully there's stability there. Street cred, you've again seen over the last year or so, the stock fluctuate, but at the same time not give very, very good returns, and therefore may be some bit of pressure piling on to holders of the stock. Valuations is a thumbs down because it's expensive, 80 times. I'd want to know whether very, very strong growth can follow the kind of valuation it commands. And then you have street coverage where there's a 15% upside, which doesn't look bad at all at a 78 times earnings. That gives TBO Tek a 6 out of 8 on our KYC ratings. And it's a very, very strong rating for a company in any case. Let's go across. We have joining us Ankush Nijhawan, who's the co-founder, joint MD at TBO Tek. We also have Gaurav Bhatnagar, who's the co-founder, joint MD at TBO Tek, joining us. Gaurav, let me start with you. On the acquisition first, you've obviously acquired Classic Vacations. It gives you a footprint into North America. Give us a perspective. Could this not have been done organically at this price? And what does it do in terms of a lever for you for growth?
Thanks. Firstly, thanks for having us over. And also my compliments on the detailed analysis you've done on the business.
Thank you, Gaurav.
It's very impressive.
Thank you.
But look, it's a fair question to ask that could this be done organically or not? And a couple of things when we look at very mature markets like North America, and look at the example of the company that we did acquire, Classic Vacations. This company has been in existence for nearly 50 years. So when you go to developed countries, you realize that the incumbent ecosystem is very mature and it is very stable. So while we have been in the market ourselves and we've been building organically and will continue to do that, right? So the TPO brand will continue to exist along with the classic brand. But if you want to have a seat on the table, it's likely going to come by acquiring something reputed in the market. You could always argue that maybe another 3 to 5 years you could build something equally large. But when we have access to capital, when there is a target available, and when we see clear synergies, it does make sense to accelerate that journey. Keeping in mind that North America is the largest luxury travel market, and because TBO focuses on the premium outbound traveler, for us to be not be in that market would cause significant struggles even with acquiring more supply or on the overall growth. So yes, this could potentially be done organically over a 3 to 5 year period. But if a good asset is available and we have the money for it, our sense was we should go ahead and do it.
Okay, Gaurav, an extension to that question. What does it do to your top line pretty much immediately? How much of the North American market do you acquire as a result of this 1,000 odd crore rupees that you've spent? And second piece is it margin accretive for you or not?
Okay. So in terms of GMV, this business adds on a full year basis, if you were to look at the prior 12 months, this business adds a little less than about $500 million of GMV, uh, which would from a perspective of what we do with rest of the country regions, it would make it probably the second largest region for us after Europe for hotel sales. So it's substantial for us from that perspective. The margin profile of this business is slightly different from the organic business, and I'll spend a couple of minutes explaining that. This business operates at a fairly high 22% take rate. The reason that take rate is so high is because the business operates on a pure commissionable model where half of the take rate actually goes back to the travel agents. So if you were to look at it from perspective of how we look at our margins, the margin is closer to half of it. So maybe about 11.5%, which is still significantly higher than our organic margins. So from a gross margin perspective, the business is accretive. From a perspective of EBITDA to revenue conversion, this business is slightly dilutive. If I have to look from a GP to EBITDA, and there are synergies possible over there, by the way. So there are cost synergies as well as there are top line synergies possible to bring it at par with what our overall numbers are. If I was to look at it as EBITDA to percentage of GTV, which a lot of travel businesses look at, so maturing travel businesses would look at the metric of how much of GTV is converting into EBITDA. And there it is clearly accretive because it is sitting at more than 2% EBITDA to GTV. For the overall TBO business, it is about 1% or probably a little bit lesser than 1%. So from that perspective, our view is that it adds significantly to our financials. The other bit I must add is the cash profile of the business. The business sits on roughly 17% of annual GTV as cash in any point of time because North America books much in advance. So it's extremely negative working capital. When we acquire the business, we get more than $80 million of cash in its all its balance sheet. So overall, our perspective is that even without realizing the synergies, when you combine the two businesses together, our view is that it improves the overall balance sheet as well as the P&L.
Okay, Ankush, I'll come to you in one more minute. Sorry, you'll have to bear with me because I want to ask one more question on this acquisition. Gaurav, what I haven't been able to cover as part of my presentation is what's the valuation multiple that you've bought this business at? Give us the cash component. Of course, you've given us that, but give us net of cash. How does it stack up just broadly? Because we've described how you trade in terms of a multiple. So just trying to understand whether it's accretive for you or not. And that'll give investors also a perspective.
No, I think that's a very fair question. Look, we are paying $125 million, around about $125 million, subject to some adjustments, for a business that for the trailing 12 months is probably going to generate a little more than $11 million of EBITDA. So that's the multiple. It's a little more than 11 times EBITDA, which we believe is a fair value to pay. I don't think we are underpaying or we are getting we are overpaying. So I think it's about the right to play, right multiple to pay.
Times EBITDA. Okay, point taken. Ankush, let me come to you. And let me expand the question a little bit. What does this do for you globally, and what are your aspirations from a global perspective? What are geographies, targets? Where is it that are pockets that you all are targeting, which are low-hanging fruit, if I can call it?
So, good afternoon, Harsh.
Good afternoon.
So for us, I think our vision is obviously to be a leading global distribution platform. And I think as we are moving forward, the approach is absolutely for us, not any geographic centric or agnostic, but the fact is certain markets for us are today matured, such as Middle East and India. But I think we will be focusing a lot and doubling down in a lot of our sales activity, especially in Europe, and Latin America, followed by Asia Pacific. But obviously now, as Gaurav mentioned, US becomes a very, very important market, and being the number one travel market in the world, I think we are very well placed now with classifications. And for us, I think the overall theme of outbound travel is beautifully growing in both in all developed as well as developing economies. So I think as TBO, we are winning somewhere already, and we will win, as we continue to move forward in across the world in meaningful travel economies.
Okay, point taken. Also, give us a lens into how many acquisitions are you targeting? Is there a geography? Is there a target market which you would like to venture in immediately, FY26? Because you still continue to sit on cash, Ankush.
Fair question, Harsh, but the fact is, this acquisition, what we did last week, is anyway a very large acquisition.
Sure.
Or at least for the time being, short and medium term, I think let's settle down and ensure that we integrate as we plan, setting up the integration with TBO and Classic in America. And then obviously start looking at other opportunities, and as I said, we are not geographic agnostic. We are open to all meaningful companies which might be adding a lot of value to the core theme of TBO Tek. But I think for the time being, we will settle down with Classic.
Got it. Ankush, what does Classic bring to the table for you? Maybe give us a 2 to 3 year lens into the overall business with Classic. Can revenue, including Classic, double from here in 3 years? Would you reckon that's a reasonable kind of number to aspire for?
As a company, we don't give any forward-looking statements.
I'm aware of that.
Absolutely, Classic will grow for us, and I think as we move, into the integration process, there'll be a lot of good learnings, on how beautifully this company had built historically in selling luxury across the world, right? So I'm sure there are certain best practices which we will also incorporate in our mainstream at TBO, because that's something which is our core theme, is obviously selling premium and luxury travel across the world.
What does this GST piece do to travel in India? Are you starting to see an uptick with regard to demand already? Is the interest going up already? And are you therefore seeing that the entire GST reform could well spur a travel wave in H2? Is that something we can pencil in?
I think I would say that definitely there should be some uptake, but as I say, it's just very early right now. Let's see how it plays up in the next few weeks. But yes, we do have Diwali around the corner, right? So there will be some short haul holidays, whether it's domestic or outbound. But definitely the GST cut will help, hopefully, the travel and tourism business, keeping in mind more disposable income and most discretionary spent by all of us in India.
Shift back to Gaurav. Gaurav, give us a sense of how this market is as a whole, and how you're placed globally given this acquisition. Does it place you at number 5, number 6? Where does it place you? And again, how large is the market, unaddressed as well as addressed, which you can continue to bite into?
Okay, so the hypothesis we work with is that global outbound travel is going to grow massively over the next 10, 15, 20 years. Why we believe it is going to grow is because of the large demographic and economic changes that have happened in the world, right? So you can see that the average age of the world is getting older. So the world is getting older at this point in time, right? Population has stopped growing. So with be the developed world or the developing world, it's going to be an older world. At the same time, income levels have historically been not and never as high as they are today. And the third bit is with the advent of AI technology, the internet, a lot of work is going to get automated. So now when we peek into the future, what we see is a world where people are, older than they are today. They are more prosperous and they have more time at their hands. Now that's a perfect recipe for a global boom in outbound travel where people start traveling from their countries to some other countries. Now, within that space, where do we operate? Now, our belief is that while budget travel, short haul travel will continue to happen online, either supplier direct, so directly on the websites of the hotels or the airlines, or through the online travel agencies. When it comes to complex travel and premium luxury travel, a lot of it happens through travel agencies. So that is the space that TBO has chosen to operate in. So we believe that we want to be the largest aggregator of offline travel demand, especially when it comes to premium and luxury travel. So now, how large is that space? It's very large. 1.5 billion outbound trips were happening pre-pandemic. Similar numbers now. So can you imagine? That's the population of India is less than 1.5 billion. That many trips happen where people travel from their country to some other country. This number has grown 5-6% every year historically, and we believe this will accelerate because of all the reasons I talked about. Now, so if I look at that as the TAM, it is extremely large. Now we can argue that out of those 1.5 billion trips, which maybe is going to be 2 billion in a few years, how much of that is going to get booked through travel agencies and how much will be self-booking? Now the specific number doesn't matter because you can say maybe it's half and half, and even then it's like a billion trips that are going to book through travel agencies. That is the space that we're operating in. Now, what does Classic do for us in this? Two things. One is Classic operates in the most prosperous outbound travel luxury market of the world, which is North America, specifically United States. Right? That is the market that drives the trend for luxury and that drives the trend for how much travel spend happens.
Sure.
So we get a foot in the door in a very large market. And while we start with the 500 million we get from Classic, we believe that the runway is very large.
Right.
The second thing that it does for us is it gives us access to luxury hotel supply,
Right.
which is really relevant for us. So that's the way
Right.
we would look at it.
Got it, got it, got it. Gentlemen, thank you so much for coming in, Gaurav, Ankush, and giving us this perspective. And viewers, thanks so much for tuning in. I hope you found this extremely relevant because KYC only operates on NDTV Profit, and that is for your profit. Stay tuned to NDTV Profit, more action on the other side.